As we close out a week that's been dominated by central bank decisions, the new week is going to be just as busy, but it's going to be more focused on inflation, the likes of the core PCE price index on Friday coming out of the US, alongside inflation data from the UK and the eurozone, and some PMI numbers to kick off the week. So volatility looks likely, and we're going to try and guide you through exactly what the outlooks are for these readings and also how to trade them. So let's get into it for the week starting Monday, the 24th of March. So let's look at the big ticket items according to Trading Economics. We're kickstarting on Monday with the PMI numbers highlighted here throughout Europe, but we've seen them around the world on Monday, the 24th of March. And Tuesday, we see a focus on Germany with the IFO Business Climate Survey coming out. Wednesday, inflation data, core durable goods coming out of the US. That inflation data, of course, on the UK there. We've got the final GDP reading for the US on Thursday. And on Friday, the GfK Consumer Confidence Survey, so another German figure, retail sales out of the UK. And then we start to see inflation data, notably out of a couple of countries in the eurozone. And we see that core PCE price index survey coming out of the US with a forecast of a move up to 0.4% on the month. And that's where we're going to start with the US. Of course, right now, everyone is looking at the US as the sort of region that is particularly troublesome, quite frankly. You have a huge amount of uncertainty. We don't necessarily know exactly what Donald Trump's trying to do. Is he trying to crash the economy to drive down borrowing costs with a view to rolling over a huge amount of debt this year? Or is he just trying to play a game of cat and mouse, and essentially he's going to find a deal rather than enact a raft of tariffs, and suddenly everyone will think that everything's hunky-dory? We don't necessarily know, but certainly the FOMC meeting that we saw in the week just gone did see Jay Powell essentially laying out an outlook where they thought inflation was going to be a bit higher, growth was going to be a bit lower, and we saw them essentially slash the quantitative tightening from 25 billion a month to just 5 billion a month. That essentially sees us drawing towards the end of that program and starts making people think, could this be a precursor to a fresh bout of QE? Well, Donald Trump has come out and essentially pleaded for the Federal Reserve to start cutting rates at a faster degree. And certainly he is very focused on driving down borrowing costs and the 10-year yield, and therefore rate cuts from the Federal Reserve would be key to that. But the Federal Reserve will be cautious unless they see that the methods and the techniques utilized by Donald Trump in trying to boost the economy essentially don't just smash the inflation rate higher, right? So if we see inflation pushing sharply higher, then the Federal Reserve aren't in a position to start to move in a meaningful manner. However, of course, that's where the PCE number comes in this week. And if we see inflation moving towards the upside, it really does start to curtail those calls for additional rate cuts or easing from the Federal Reserve. Part of that is this surge that we're seeing in terms of some of the manufacturing surveys of late within the prices element. So you can see here the Philly Fed prices paid element, the Empire State prices paid element, and the ISM manufacturing prices paid element, all pointing towards the manufacturing sector seeing a sharp surge in input prices, and that points towards the possibility of a resurgence for inflation. Now, as we can see here, the red line and the green line are both essentially sideways. So we haven't seen a big uptick in terms of inflation as a result of what Donald Trump's doing. But of course, we still haven't seen the reciprocal tariffs come into play. And so this really is in its infancy. But certainly if we see those signs that inflation is starting to resurface, it really could start to hinder market sentiment further. We can see here the breakdown in terms of core inflation. We've got the core CPI and the core PCE. CPI significantly higher than the PCE at 3.14, PCE at 2.65. We can see here that the most recent figure for February on the CPI number came closer to that 2% mark. So thankfully, we saw a move lower in terms of the CPI, the core CPI. This time around, we have a metric from last year of February at 0.2%. So are we able to essentially get at that level or below to be able to try and either see PC flatline or decline? Now, markets are expecting a figure of 0.4%. So it points towards a possibility that people do start to worry about inflation rearing its head once again. The 9-month annualized does put that PCE figure at 2.4. So there is a chance that we get closer towards that core PCE figure being around 2%. But, arguably, we're not necessarily on track to get down to that actual 2%. And then things by the mid part of the year probably start to lift up once again. But really, the monthly metrics are going to be absolutely key here. If we see a surge in terms of monthly inflation up to 0.4, that's a bit of a warning sign, quite frankly, because it's pretty much double where we need it to be. And it points towards the possibility that markets are thinking in a sort of inflationary perspective. Of course, right now we're talking about the possibility of a recession, right? And that isn't necessarily the environment where people think prices are going to surge ordinarily. And therefore, it just comes down to tariffs. Are tariffs going to start to lift expectations and drive prices higher? Notably, what we've been seeing here under Donald Trump is a sharp decline in terms of Treasury yields. Now, the decline in Treasury yields is one of the main reasons why we're seeing weakness in terms of the US dollar. But it's a good thing, right? In terms of the borrowing costs in the US economy, a decline in terms of yields will provide the basis for them to roll over much of their debt at more advantageous prices. And given the huge pile of debt that they've got in the US, that's something that they're clearly targeting over at the White House. Now, if you're looking in terms of the relationship between the CPI figure and the 10-year yield, you can see here that the monthly CPI numbers generally correlate fairly well with the 10-year yield. Now, there can be a bit of a lag, and that's why I've put a 1 month adjusted on this. I was looking at 2 or 3 months previously. You can see the peak sort of shift. But ultimately, what we're seeing at the moment is a sharp decline in terms of the 10-year yield. The 10-year yield can go lower on expectations of lower inflation, but we haven't necessarily got that at the moment. People think we're going to see higher inflation. Instead, we're seeing that 10-year yield being hit hard because people are expecting to see a greater degree of easing from the Federal Reserve because of the question marks about the economy. And also, you're likely to see higher demand for the treasuries at a time when equity markets are selling off because people are looking for havens, and the US 10-year is exactly that. Higher demand means the yield is lower, and so we're seeing weakness in terms of the yields. Now, if you're seeing the relationship between here, let's just jump onto the chart. So if you're looking at the relationship between the likes of the US 10-year and the likes of the dollar, we can see that here. So the relative relationship between the US 10-year and the European 10-year, the Euro 10-year, overlaid against the dollar index. Remember, Euro dollar makes up a huge chunk of that dollar index metric. Essentially, if US yields fall faster than those in other regions, most notably Europe, then you're looking at the potential for weakness for the US dollar. It's exactly what has been happening recently. And so the question mark here is whether we are looking at a release in terms of inflation that's going to help or hinder that recent decline in terms of US yields. I think there's a good chance, if we're looking at that 0.4 that some are pointing towards, if we see that 0.4, then we could possibly see a bit of a rebound in terms of this relative yield relationship between the US and the euro, and that could give us a little bit of a bump in terms of the US dollar. But certainly, if you're looking at the sort of trajectory recently, we have been seeing this very sharp decline. We've now come into this key support level down here, which is roughly 103.3. Now we're seeing a bit of a bounce. I think if we do break up through your near-term resistance that we have here, which is 104, there is a chance we could see a little bit of a near-term pop. And especially if we were to see inflation coming in hot this time around, then you're looking at the possibility of us to unwind that recent decline in terms of the US 10-year yield and start to push a little bit higher as people start to think, well, the Federal Reserve don't necessarily have the capacity to move much beyond their current pace, which is 2 rate cuts this year, which has been penciled in by the dot plot. And, if inflation rears its head, then that whole stagflation issue comes around, and they can't ignore inflation to just keep cutting. And so there's question marks about whether we could see yields move upwards. The caveat to that is, of course, that we have heard from Powell, who essentially said, if we did see inflation as a result of tariffs, we would see it as a one-off hit and not necessarily something that is indicative of a major problem within the economy. And so he could potentially look beyond that. So that might weaken the story in terms of that rebound. So, if inflation comes in lower than expected, and bearing in mind it's 0.4, that's relatively lofty, then we could see further downside here. But look out for that relative relationship between the US and Euro 10-year yields. So that's the dollar index, right? We've got a possibility of a little bit of a rebound if we see a relatively strong inflation metric coming out. Keep an eye on those PMI numbers on Monday as well, because, of course, you're looking out for something that points towards the possibility of a recession coming to pass or not, as it may be. And certainly, if we see relatively strong numbers, then it sort of allays those fears and possibly also manages to see the US dollar start to move towards the upside. In terms of the UK, like I said, we've got those PMI numbers coming out on Monday with an expectation that we see improvement across both of them. We've just come off the back of a Bank of England rate decision that saw them take a relatively patient approach. 8-1 was the vote to pause. Markets were expecting 7-2. And so it says, well, right now they don't necessarily feel too desperate to ease at a rapid pace. And part of that is because of the concern around inflation and the ability to get it back down to target. You can see here the expectation is we do see a sharp decline in terms of headline inflation this time around. But the core reading, while we're expecting declines, we're expecting to see it come down to 3.5. That's still well above that 2% target for UK inflation. Now, this is the breakdown for UK inflation. You can see here that it's been moving towards the upside. However, we've cleared out that January metric where you can see the comparative is a very negative reading from last year. And now we're into this period where we've got 4 months of significant disinflation that's likely. February, we've got 0.6 on both core and headline that's dropping out. And therefore, like we've seen in terms of market expectations, we can see significant disinflation. But we can see the same for March and the same for April and to an extent May as well. So I think the disinflation is going to come thick and fast. You can see that in terms of the 8-month annualized metrics, 1.67, 1.59. So there's a good chance that by, in 4 months' time, we see UK inflation well below that 2% target. And therefore, the Bank of England can take on a more dovish stance in the months ahead. But right now, they're taking a cautious approach because I guess it makes sense, right? We have a lot of uncertainty around what's happening in terms of Donald Trump and the tariffs. And even though the UK hasn't necessarily hit that much, negatively impacted that much because UK has a trade deficit with the US, there's still question marks around the global economy and the global picture for inflation. And the Bank of England are reacting as you might expect them to. So you've got these relationships in terms of relative bond yields, and that's worth highlighting here in terms of the cable pair. So we've got the likes of the pound against the US dollar and the US versus the UK 10-year yield. That highlights essentially the potential trajectory for cable if we were to see something that drives up the US 10-year yield, like we're talking about previously, but also the same for the UK, of course, with the fact that if we look back at the economic calendar, the fact that we've got inflation coming in weak, if we saw weak inflation, like we're expecting, 2.7 to 3.5, and it starts to point towards, like I said, a sharp decline in terms of inflation pressures in the UK, then suddenly you could see a bit of a bearish pivot. So if on the same week we see relatively strong inflation out of the US and then the UK starts to see potential weakness in terms of the UK inflation picture, and people start to realize what's happening in the coming months, you might see some weakness for cable as we go forward. So we'll bring that up as well. I'm aware of the fact that, we're seeing some overlap in terms of these FX pairs because we're talking about the US dollar once again. But let's just quickly bring that up for you guys. So you can see here, we've seen this strong move towards the upside. By and large, we're still within this sort of big choppy area that's been respected, essentially this big choppy area that we've been trading within over the course of the past year and a bit. And you can see here, we're sort of rallying up. Are we seeing a retracement? Are we not? Time will tell. But certainly, I think at the moment, there's a bit of a question mark for the week ahead in terms of the direction of travel for UK rates if we see inflation coming down in the way that it looks likely to be the case. So look out for a potential breakdown through your first swing low that we have around here, which is 1.291. If we see that, then we could see some weakness and a wider retracement coming into play. Most notably, if we're in a position that sees the likes of the UK inflation picture moving sharply towards the downside. Next up, let's look at the outlook for the Bank of England and see exactly where we stand in terms of market expectations off the back of that meeting. We can see that right now, the next rate cut is most likely to happen in June. And beyond that, you're looking at potential chance for a second rate cut this year. And this will change quite significantly if we do see that massive disinflation coming to the fore. And certainly if you're looking at a potential rate cut in June, well, arguably, I would say by that point, we could see UK inflation pretty much below that 2% target. And it emboldens the Bank of England to be able to cut rates at a faster clip. So this could change. And if it does, it's likely to change sentiment around the pound. And one area to trade it would be against another currency other than the US dollar. And that's where the fact that we have a whole raft of data coming out of the eurozone comes in. So again, we've got PMI numbers coming out on Monday. We've got the IFO business climate on Tuesday. We've got the ECB meeting minutes on Thursday. And then Friday, the GfK consumer climate and then inflation data coming out of France and Spain as a precursor to the wider inflation data coming out the next week, essentially. So the PMI numbers will be interesting. They are for March, so they're up to date. And we're talking about sentiment within these surveys, and certainly the manufacturing area is going to be particularly important. Of course, right now we're looking at a potential resurgence in terms of eurozone and European manufacturing. If we see all of this huge stimulus coming to pass and a ramp up in terms of defense spending, possibly things start to improve quite significantly. So we'll be watching that closely. And then on the inflation side of things, well, we've already got really significantly low inflation in the eurozone. We can see that here with these figures all around that 2% mark, or even in the case of Italy, down at 1.58, France down at 0.8. So very low numbers. Bearing in mind, like I said, we've got the French and the Spanish numbers coming out. So France makes up 20% of the eurozone CPI number. Spain makes up 11%. And therefore, you've got a third of the CPI number coming out over the course of Friday. It gives you an idea of where that headline figure is going to go from here. Like I said, there's a relationship when it comes to yields and the FX markets. And what we've been seeing recently in particular is upside in terms of eurozone yields as people start to essentially react to these news headlines in the eurozone that revolve around the idea that they're going to spend a huge amount more money, they're going to take on a lot more debt, they're essentially going to have to fight this war without the US. All that stuff starts to push up yields because people essentially become concerned about the fiscal stability of the region. And so higher yields provide the basis for moves within the markets. And, like I was talking about, if we're trading the pound against the US dollar, well, another way of doing it is trading the euro against the pound. And we can see that here, a wider downturn that we have been seeing playing out. More recently, a surge in terms of that euro 10-year yield relative to the UK, as people are seeing the likes of Germany now suddenly starting to change their rules around borrowing. That provides the basis for potential upside in terms of the European yields. Let's just jump into the likes of euro sterling. And what we can see here, let's look on the sort of wider context. Here we go, is a continuation of that wider trend as things stand. This has come in the wake of that Bank of England meeting with a relatively hawkish stance, some would say, from the Bank of England, a very patient approach. And now we're seeing the potential for this week to end with a bearish engulfing pattern. So the trend still remains in play here. And you can see here over the sort of nearer term, we've got this double top formation with the neckline in play around your 0.837. That forms the potential basis for weakness when it comes to euro sterling. A lot of this is going to come down to, again, the relative relationships when it comes to the two in relation to yields. And arguably, you'd say, well, there's a good chance that we see the UK yields come down as inflation comes down. Will we see that happen this week in terms of significant disinflation? People start to think that that has a major knock-on implication for the UK yield. Potentially the case. So I don't know if it's going to happen this month or next month. But there's a good chance that soon enough we see further weakness in terms of UK yields relative to the eurozone. And certainly when we're seeing this possibility of a ramp up in terms of spending and debt in the eurozone, that points towards a possibility that we bottom out at some point here, right? You can see here that we've got this area of support down here. So does this trend end soon enough? Well, perhaps. But the relatively hawkish stance from the Bank of England had something to do with this decline that we're seeing at the moment. And ultimately, the trend is your friend, and the trend still remains in place. So we would need to see a breakup out through this 847 resistance level for euro sterling to tell us something other than that this trend's going to continue. And at the moment, we've got a double top formation as highlighted on the 4-hour chart, which points towards a possibility of downside. Keep an eye out for those PMI numbers. Do we start to see signs of distress? Of course, we've got the reciprocal tariffs coming their way on the 2nd of April. And we've got those inflation metrics out of the eurozone. But arguably, inflation in the eurozone is set to collapse over the coming months. And therefore, that provides the basis for people to think that the ECB is going to ease at a faster pace. But they've already done so much easing that, arguably, that wouldn't necessarily mark a huge shift from the norm. Whereas the Bank of England have been very cautious with their approach to easing. And I think that soon enough, we're going to see markets cotton on to the idea that we're going to see massive disinflation in the UK that takes us back down to levels that will force the hand of the Bank of England to quicken their pace. I hope that's been useful. Make sure to like, subscribe, follow for more content like this. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Thanks a lot.